Yeah, I mean, the Fed's a bit behind the curve here, and they need to get moving. And remember, an oil shock doesn't really help the Fed out. It kind of creates, puts them between a rock and a hard place. On the one hand, it weakens growth. On the other hand, it adds to inflation. And so it really doesn't prevent them from following the path they were on to begin with. I think the markets have been a little too focused on the growth picture and are not paying enough attention to the fact that there really is a serious inflation problem.
I think people are also looking to the financial markets, Ethan, and going, wait a minute, the stocks are down and the VIX is up, and this is rarely the setup that they like to start tightening into.
Yeah, the thing about the waiting now is that you could have made an argument that the Fed should have started hiking last fall. And now they've finally agreed and are setting the markets up for a steady diet of rate hikes. It'd be kind of odd to kind of admit that you do need to normalize and then not to even do that one small hike. Remember, they're not trying to hurt the economy, and one hike isn't going to hurt the economy. It's about a process of gradually getting back to normal, putting the funds rate at a place where it should have been. Probably we should already be on that path right now.
Our guest earlier this hour, not an economist, but just said, given what's happened with the oil price, he thinks a recession and demand destruction are kind of the only ways to rebalance that market. What would your response as an economist be to that?
I disagree. I mean, this is a serious shock. For the U.S., it hits an economy that's got strong momentum, a lot of savings in the household sector where they can, at least for middle and upper income families, can handle the higher prices. It is tough on low income families, no question about it. But there's a pretty strong economy here. I don't think this is a big enough shock to cause a recession. I think we would need kind of a worst case scenario with a major shock to the oil markets to start talking about a recession.
Yeah, and that means that actually it would take a lot higher oil price for demand destruction to set in, right? And that's why people still are worried about a continued move higher. What about those who say, well, 2008 sent us into recession, this pattern always plays out?
Yeah, well, let's remember, if you go back into history, you really have to kind of think about all the events that were going on at the time. The 2008 experience is called the Great Financial Crisis for a good reason. What caused the recession was primarily the collapse in credit markets, the banking system, and the housing market. Oil was kind of an add-on to that. Certainly added additional pressure. But my view would be that if it had just been higher oil prices and you didn't have all those other problems, we probably would have coasted through that period with weak growth. So I don't think that proves that oil is this all-encompassing thing that always creates recessions. Recessions usually require a combination of factors, and oil is just one of them.
Ethan Harris, thank you for your time. Sticking to your call, we appreciate the explanation. Thanks for joining us today.
Shepard Smith here. Thanks for watching CNBC on YouTube.